Hello students and welcome to video 2 in chapter 3.7 cash flow. So in the previous video we looked at how we can construct cash flow forecasts, which is the majority of the chapter I would say, but there are lots of other learning objectives which we're going to cover during this video. So firstly, we need to look at the difference between profit and cash flow. And these are pretty similar, but there are some differences between them. So just to emphasize, profit equals revenue minus total costs. We did that in a previous chapter. Cash flow is cash inflows minus cash outflows. Now, when you first look at it, these look to be the same because revenue is an example of a cash inflow and total cost is an example of a cash outflow. Now, many situations, these are quite similar, but there are certain situations where these vary. So firstly, let's look at a situation where they are the same. So we looked previously at Minto's mugs, and their sales for the first 4 months were 40,000 for January and February and 60,000 for March and April. Now, in this situation, the revenue will be 40, 40, 60, 60. And in this situation, there's no reason that they don't collect the cash in those months. So we can say that the cash inflow is 40, 40, 60, 60. So then why might they be different? Well, let's change the example. So we've got the same formula, the same revenue, but instead, Minto's mugs now give their customers 30 days trade credit. Now, in this situation, the customers are the shops. When we say 30 days trade credit, we're basically going to say they give them a month of trade credit. Now, we get a situation where revenue and cash flow are different. In this situation, the revenue is still going to be the same using our assumptions. The revenue is going to be the same as before because in this situation, the revenue is collected when they make the sale. So they sell the mugs in January, so therefore the revenue is 40. However, because the customers can pay 30 days later, they won't collect the cash until February. So you can see that the revenue for January, the cash is collected in February. The same for February. The revenue in February, so they sell 40,000 worth of mugs in February, but they won't collect the cash until March. So we don't put that into the cash flow until March. And then we just follow through the same logic. The 60,000 collected in March is the revenue, but then we don't collect that cash until April. So it won't go through the cash flow until April. And so February, they're the same, but that's only because January and February have the same numbers. But now we can see in March, the business has made 60,000 in sales, but they're only getting 40,000 in cash because of that 30 days delay in actually collecting it, and they won't get the 60 until the next month. This is, of course, making the assumption that all customers pay exactly 1 month later. Some customers may end up paying earlier in theory. So what that does is we can then now look at the main difference. The main difference between profit and cash flow is timing. And we can see that because the cash, we only put the cash on the cash flow when we actually collect it. And that's different to when the revenue, which is when we actually make the sale. So here's just to summarize that. Cash might be collected from customers later because the business might give customers trade credit. Just to add to the complications a bit more, when this business itself, so in this situation, Minto's mugs, they're going to be paying their suppliers for the raw materials to make the mugs. And it might be that their supplier gives them trade credit. So in the cash outflows, they're going to be paying for their raw materials 30 days later. And we would just do the same thing where through the cash flow, we delay those cash outflows by 30 days, but in the costs, it would still go through when they actually buy them. So in this situation, we now get a possibility where a profitable business can have cash flow problems. And this might just come down to the fact that they pay their suppliers on time, but give trade credit to customers. So managing this relationship is really important. Ideally, we want the customers to pay as soon as possible. We want to pay our suppliers as late as possible in theory. Another example might be expanding too quickly, but we'll get to that on the next slide. Okay, so causes of cash flow problems. So why might we have problems with cash flows? Well, the first one might be quite simple. It might just be an unprofitable business. So the business is making a loss. Eventually, that will catch up with cash flow because if they're making a loss gradually over time, the amount of cash that the business has will go down and eventually that will go into negatives. Giving too much trade credit to customers, we saw that on the previous slides. If we give too much trade credit to customers, then we're going to have to wait for the cash to come in. In the meantime, we've got to pay our suppliers, we've got to pay our workers, etc. So that's another reason we might get cash flow problems. Expanding too quickly means that we'll see this on a later slide. If we do expand quickly, then we're generally going to have to pay money in order to expand. So maybe we need a bigger factory. So we're going to have to spend a lot of money up front to buy a new factory, but then the profits will come at us slowly over time. And that can also cause cash flow problems, as we'll see a little bit later. Having too much stock, this can be a problem. Basically, if we've got a lot of stock, then we paid money in order to produce that stock, but maybe it takes time to sell. So in this situation, we've got to pay our suppliers in order to make the stock. But then if it takes time to actually sell the stock, then we have to wait for the cash to come in, and that can end up causing cash flow problems. And finally, what about seasonal demand problems? So if you look at a ski manufacturer, you can see that a ski manufacturer is going to have higher sales during the winter than the summer. And so therefore, during the winter, their cash flow is likely to be very healthy. But what about during the summer? They're not going to have as much money coming in. So they're going to need to plan for that accordingly. So how can we solve any cash flow problems that we might have or we might see in a cash flow forecast? Well, this comes down to basically two things. One is to improve cash inflows, and another one is to reduce cash outflows, we'll see in a minute. So how can we improve cash out inflows? Well, one way might be to improve credit terms. So here we might reduce the trade credit we give to customers. So for example, if we give them 60 days, maybe we only give them 30 days. If we give them 30 days, maybe we don't give them any trade credit at all. That's going to improve our cash flow. Of course, we might end up losing some customers. Some customers might say, well, we're going to go to another company who does give us trade credit. So that's one of the possible downsides. But it does mean that they collect cash quicker from their customers. Any source of finance, so any bank loan, share capital, any sort of crowdfunding, that's going to lead to money going into the company. And so that's one way we can solve that cash flow problem. We can sell assets, machinery, factory, patents, etc. Again, that's going to lead to cash inflows. Or some sort of short-term promotion. So, for example, we could give 20% off on all of our products. If we gave 20% off on our products, that would in theory lead to higher sales, which will bring more money coming into the company. The problem with that, you can probably see, is then that's going to reduce our profitability. So again, this is another difference between profit and cash flow. This will help cash flow, but be bad for profit or profit margins, certainly. We can also reduce cash outflows. So we could find cheaper suppliers, we could spend less on our inputs. Again, this would improve profit margins, lead to better cash flow. We could delay payments to creditors. So we could say to our suppliers, can we pay 60 days later rather than 30 days later, or 30 days rather than paying for it now? And that means that we've got more time to sell the product before we have to pay for our suppliers. So you can see the credit terms help both inflows and outflows, and businesses need to manage that very carefully. We can delay spending on capital equipment. So maybe we want to buy a new factory. Well, what we could do, we could wait. We could build up our profit. We could use our retained profit, put it away. And then when it's big enough, we could use that to spend on capital equipment so we don't expand too quickly. We could cut unnecessary overheads or expenses. We could also reduce stock. So in part of the HL syllabus is just-in-time production, where we try and hold very low levels of stock. And so we don't have as much cash tied up in stock overall. Et cetera, et cetera. There are lots of other strategies, but these are some of the main ones. So finally, working capital and the liquidity position. So working capital we've done before is funds available for the day-to-day running of the business. This then leads to something called the working capital cycle, which is the period of time from buying inputs to receiving cash for sales. And this is very similar to the credit terms we were talking about in the previous slides. So just to go through the working capital cycle. So first off, we have to pay suppliers. So this is cash out. So we pay suppliers and employees in order to get the raw materials. We then produce goods, and then we sell the goods. And only once we sell the goods does the cash come in. So you can see that when we pay suppliers, the cash is going out, and then we have to wait and go through this cycle for the cash to come in. And then we use the cash to come in to actually pay for the cash to go out. But you can see that this period of time can cause cash flow problems. And if it's too long, then we have to wait too long for the cash to come in, which again can lead to cash flow problems. So the longer the time period is between the buying of the inputs to receiving cash for sales, the longer it takes to actually collect the cash from selling goods and services. And this leads us on to liquidity. So liquidity is how quickly assets can be turned into cash. And you can see that we want to turn these raw materials into cash, but this is going to take us some time. So again, with credit terms, if we give trade credit to customers, then we're going to have longer for the cash to come in. But if we get trade credit from suppliers, then this cash out can actually be later in the process because we don't have to pay them until later. So finally, I think I said finally already, but there is one more thing, which is the relationship between investment, profit, and cash flow. So just to specify what business investment is, this is another chapter within the syllabus. But basically, investment could look like various things. One is spending on fixed assets. So this was capital expenditure we covered in the previous chapter. So this might be spending on a new factory, research and development, etc. Another example might be if the business expands overseas. So how is this going to impact profit and cash flow? So firstly, the investment there's going to be a large amount needed. So for the business expanding overseas, maybe they're going to need to buy shops or factories overseas. They're going to have to do advertising, and then they're going to have to end up doing the production as well. So the impact on profits, if they do expand overseas, then in theory, the investment should lead to higher future profits. Otherwise, they wouldn't actually make the decision. So the business is saying, in the long run, we're going to have higher future profits because we do this investment. But what's the impact on cash flow? Well, the impact on cash flow is going to have two effects. At the beginning, there's going to be a large outflow of cash because they're going to have to pay for these things here. They're going to have to pay for the buying the assets, etc. But in the long run, as the profit goes up, then they're going to see small cash inflows as the project progresses. So you can see at the beginning, there's going to be a large outflow, but then over time, there's going to be a small positive inflow. So this can lead to cash flow problems in the short run because there's going to be a large outflow. So when doing those cash flow forecasts, they're going to have to actually forecast this big outflow in year one, followed by small ones coming in over time. So they'll need to either take out a loan, use retained profit, or any of those sources of finance that we covered in the previous chapter. All right, finally, that is all the learning objectives done in chapter 3.7. I'll see you next time.